In this section, we will be discussing the neutrality theory, the basic 3D2 rule, the concept of ownership change, the concept of a 5% shareholder, a testing date, an owner shift, and the concept of an equity structure shift. Also, we'll discuss what is a testing period, the concept of pre-change loss and post-change income. We'll define what a loss corporation is and compute a Section 3D2 limitation. Finally, we will apply these concepts using a couple of illustrations of common startup company fact patterns. Section 3D2, as it's currently enacted, regulates the ability of a company to utilize its historic losses against future income to the extent it has experienced an ownership change. It does this by applying the neutrality theory. The neutrality theory is designed to eliminate the worth of the tax benefit from the decision of whether or not to invest in a corporation. It does this by applying a reasonable rate of return on the worth of the assets of the corporation. So, theoretically, the more valuable those assets are, the higher the rate of return would be, and hence the higher the theoretical 3D2 limitation. For extremely valuable assets, the 3D2 limitation would be correspondingly very high. For very low valued assets, the 3D2 limitation would be relatively low. Where a loss corporation experiences an ownership change, the 3D2 limit is essentially the value of the company immediately before the ownership change multiplied by a rate, what we call the applicable federal rate. The applicable federal rate is published on a monthly basis and fluctuates together with interest rates available in the market. By applying the limitation to the historic losses in this manner, the historic losses become a neutral factor in the decision of whether or not to invest in the company. Simply put, the target's historic losses are only as valuable as a reasonable rate of return would be on the investment in the company's other assets. The basic rule of Section 3D2 is that after an ownership change, a corporation may only use its pre-change loss to offset post-change taxable income in an amount equal to the annual Section 3D2 limitation. An ownership change occurs when the 5% shareholders experience a 50 percentage point increase in their ownership when measured in aggregate over a testing period. So there are three concepts presented here: a 5% shareholder, a testing period, and a testing date. In determining whether a 50 percentage point change has taken place among 5% shareholders, it's important to know who are the 5% shareholders. 5% shareholders are generally individuals. As with many corporations, there may be a grouping of 5% shareholders and non-5% shareholders. In that case, the non-5% shareholders are typically grouped together and identified as one public group, 5% shareholders. The individual shareholders are themselves identified as individual 5% shareholders and are tracked through a historic period, the testing period. Why 5%? The reason that the statutes or the regulations reference 5% shareholders is because of a requirement for public companies that any shareholder that owns 5% or more of the stock of a corporation, of an SEC registrant, must file certain forms identifying its ownership percentage and identifying its ownership intent. This establishes a degree of transparency and is required under penalties, under criminal penalties. In other words, if a 5% shareholder does not file the forms, then they may be subject to criminal fines. And in that respect, the 5% threshold tends to be a very reliable threshold in the context of a public information gathering process. A testing date is the date on which a corporation must undergo a test to determine if a 3D2 limitation applies. A testing date is generally the date of an owner shift or an equity structure shift. An owner shift occurs simply when one shareholder, a 5% shareholder, transfers its stock to another party. It could be that the other party is an existing shareholder or a new shareholder. An equity structure shift results from a reorganization that is defined in Section 368 or often through stock issuances. In this diagram, an owner shift would take place where A, as owner of X corporation, transfers all or a portion of its stock to B. In this case, the ownership of the company has shifted. In an equity structure shift, A is an owner of X corporation and B invests directly into X corporation in exchange for newly issued shares. That may represent an equity structure shift. An equity structure shift and an owner shift represent the need to apply a testing date. What is a testing date? The testing date takes all 5% shareholders and determines and compares their ownership on a testing date with the lowest ownership percentage that they have had over the 3-year testing period. So the testing period is a 3-year look-back period from the date of any testing date. So looking at this diagram, the testing period takes the 5% shareholders on a testing date, compares their relative ownership percentage of the company on this date with the lowest ownership percentage over the testing period, which is a 3-year rolling period looking backwards from the testing date. There is one exception here, and that is where either the corporation has not been in existence for the full testing period, or there has been a 3D2 change at some point within the testing period. In both of those cases, the testing period may be shorter than 3 years. So to recap a bit, a corporation that has net operating losses may experience some change in the ownership makeup. If there has been an owner shift or an equity structure shift, there is a need to compare the owners on the testing date, the date of the owner shift or equity structure shift, with the lowest ownership percentage that they have had throughout the testing period, to determine if in aggregate there has been a 50 percentage point increase in any group of 5% shareholders. If a company experiences a 50% or greater change in their 5% shareholders, then that company has experienced an ownership change that would subject it to a Section 3D2 limitation. And so what does that mean? To the extent a corporation has experienced a ownership change and has a 3D2 limitation, then its pre-change losses may not be utilized against post-change income. What are pre-change losses? Those include net operating losses, capital losses, and net unrealized built-in losses. So what is net unrealized built-in loss? Net unrealized built-in loss is essentially an aggregate loss in the assets of the corporation. If you took a snapshot of the corporation's balance sheet, comparing the value of the assets against the adjusted tax basis, if in aggregate that produced a loss, then there would be a net unrealized built-in loss. In that respect, a corporation wouldn't have to have any accumulated net operating loss or capital loss in order to have pre-change loss. The loss would be inherent in the assets of the company. To the extent there has been a 3D2 limitation, that limitation limits the amount of post-change income that can be offset by pre-change loss. And so to the extent there is a Section 3D2 limitation, the Section 3D2 limit would equal the fair value of the corporation immediately prior to an ownership change, multiplied by the federal rate, applicable federal rate, which is published monthly, to produce the annual 3D2 limitation. This is an annual limitation that applies each year. To the extent the annual limitation is not used in any one year, it is carried over to a subsequent period. And the final observation is that if there are multiple limitations, then often the lesser of the limitations will apply. These are general considerations for Section 3D2, and ones that we will get into in much greater detail through the course of another module, but beyond the scope of this discussion. Essentially, the 3D2 limit is the fair value multiplied by the applicable federal rate to get to you an annual limitation amount. This is the amount of loss that can be brought forward into future periods and used against post-change income. So how is this relevant to startup companies? Startup companies are often not profitable, spending the equity-infused capital on expansion and development of products, development of IP, for instance, and in that respect are generating a significant amount of losses in their earliest of years, the formative years. Corporations that are in startup mode are often looking to build out valuable technology or products with the hopes of being acquired, often before they even show any signs of profitability. In order to develop their technology and products, the corporations often look to equity markets to fund operations. Often the debt markets and bank loans are not available since the corporation has not yet proven its ability to generate an amount of profit or a valuable asset to essentially permit the company to pay back the loans. So the companies will often look to equity infusions to help fund future development. As we had previously mentioned, equity rounds are not only subject to the operational aspects and the performance of the corporation, but they're also subject to broader market conditions. And in up markets, to the extent a corporation has multiple rounds of equity infusion, then each round may be priced sequentially higher. In down markets, there may be a round or two that is priced lower than a predecessor round. In addition to raising capital, each round of equity financing may present an instance where a company is experiencing a change in the makeup of its owners. That change may create the need to apply some analysis around Section 3D2 to determine whether there has been an ownership change. Of course, corporations are typically reluctant to make such an analysis when there is no prospect of profitability or an acquisition. Where there is an acquisition, however, a corporation should have a solid foundational understanding of where it stands from a 3D2 perspective before it enters into meaningful negotiations with potential buyers. That said differently, a buyer will typically come to a negotiation with a perspective on a target's net operating losses. The perspective of a buyer will often be if the target doesn't have an analysis to demonstrate the worth of those historic attributes, I will, as buyer, assign zero value to those attributes and pay the selling shareholders nothing for the worth of those attributes. After the fact, a buyer may itself conduct some analysis around 3D2 and develop a more complete perspective and potentially even benefit from those historic losses to the extent a 3D2 limitation is high enough to permit the use of the losses. Let's look at a couple of illustrations in the context of a startup. The first illustration represents a equity infusion involving increased equity infusion, while the second illustration will illustrate a decrease in the amount of equity infusion. So in this first illustration, A contributes $100 to X Corporation in year 1. X Corporation loses that $100 or spends that $100 and generates a net operating loss. Let's assume also that B in year 2 contributes $1,000 because of an increased value of X Corporation. That $1,000 is available for disposal by X and is spent on items that would generate another $1,000 of net operating losses. If the investment by B resulted in a 3D2 ownership change, the 3D2 ownership change would have occurred before the $1,000 investment would have been spent, meaning that the 3D2 limitation would theoretically apply to the $100. The $100, assuming a value of 100 at the time of the 3D2 limit or immediately before the 3D2 limit, that would essentially produce a 3D2 limitation of based on the value of 100, assuming an applicable federal rate at the time of the ownership change of 3%, would generate approximately $3 of limitation per year. The total amount of loss carry forward into year 3, assuming X Corporation in year 3 generates profitability. If in year 3 X Corporation generates profitability of, call it, $1,100, then that profitability would be offset by the $1,000 generated in year 2 after the ownership change, plus $3 generated in year 1 based on the $100 valuation. Let's look at the contrary illustration. This is an illustration where we have a down round and a potential choke point on 3D2. In this illustration, assume that a individual invested $1,000 in year 1, bringing the relative ownership percentage change to 49%. Let's assume that X Corporation spent all of that $1,000 and generated an NOL in year 1 of $1,000. If in year 2, B invested $100 in X Corporation to fund additional additional development, and that $100 tipped the scales, causing a percentage shift from 49% to 50%, then a 3D2 limitation will have been applied to the losses generated from year one. If the value of the loss corporation at the time of B's investment had deteriorated or decreased to $500, then the amount of the annual 3D2 limitation would be 15. And if in year 3 X generated a sufficient amount of income, then only $15 of the $1,000 would be subject to use, while all of the $100 would be subject to use and available. So the $1,000 would be greatly limited by the 3D2 limitation represented by this down round. So in that respect, a down round can be, call it a choke point for 3D2 to greatly limit the amount of historic losses and the historic loss buildup up to a down round. This can be particularly problematic for corporations who are, generating either profitability or are hoping to obtain some sort of value for their tax asset of net operating loss. This can be particularly problematic for companies that are about to generate profitability or about to be sold, as their losses may be greatly limited. To recap some of the points discussed in this segment of the presentation, Section 3D2 is of particular importance to startup companies where they are experiencing rounds of equity capitalization. With each round of equity capitalization, the company is able to fund operations, but also is potentially changing the makeup of the ownership population and the investor base. To the extent the owners of the company change, then Section 3D2 needs to be analyzed in great detail before a transaction or before a company is about to embark upon profitability. In those instances, the 3D2 limitation may impact the value of those historic losses going forward. And to the extent a down round occurs where a equity infusion, perhaps late after several rounds of equity, is less than prior rounds of equity, that may represent a choke point for Section 3D2 and greatly reduce and limit the amount of net operating losses that a corporation can use. And with that, I'd like to thank you for viewing this module on loss creation and Section 3D2 for startup companies. You can look for updates on related topics, including Section 3D2 detailed analysis, consolidated Section 3D2, planning for Section 3D2, loss creation and private equity, and then cancellation of indebtedness and its relation to net operating losses. Look for updates on Twitter at LumiNational and at our website at www.luminational.com. Thanks for joining me.